This is the most base level thing that you can learn. It's not that hard to get your head around, but it is a lot of work. I mean, I spent at least like 30 minutes working on this. Buy low and sell high. It's important not to get those out of order. Some traders do, contributing their entire life savings to some banker's third vacation home. And this is about 90% of traders. I might be in there. Strategy is the only way that you'll ever escape this. Let's just look at what other successful investors do, since they clearly know what they're doing. Copy parts of their strategy and then just build our own. Value investing is when you find something's intrinsic value and buy it whenever it's under that value. Here's half the definition from Google, but basically intrinsic value just means fair value for a company. If you had to chart a company's intrinsic value, you could see that it's moving in a largely linear fashion, meaning it's not making rapid jumps up or down. When you overlay the stock price, it's a whole different story. A company's stock is always going to be dipping below or cresting above the intrinsic value, and the two rarely ever meet. There's millions of people out there looking for undervalued stocks, meaning that it's very rare to find anything undervalued, because all the good companies everybody else knows are good companies, so they're going to be trading above their intrinsic value. But for shits and giggles, I think I found one. Let's just think in a hypothetical scenario that we're trying to buy an entire company. Nike is an American athletic footwear and apparel corporation headquartered in... You know what Nike is. Looking through their financials, Nike made $51.25 billion in revenue last year. Subtract all the expenses that it costs to keep Nike running, and we have $6.2 billion in something called free cash flow. This is in theory what the owners could have taken home in profit. Looking at free cash flow for the last 10 years, we can see that it has been growing at a pace of 13.4% on average every year. Based on this, we want to look at our hypothetical and see how much it would cost to actually buy Nike right now. We're going to find the intrinsic value of Nike based on how much money it could potentially give us in profits over the next 10 years, and if we were going to sell it on that 10th year. To keep it simple, let's just say that the trend of 13.4% every year continues for the next 10 years. You would just add 13.4% to every ending value for the next 10 years. Repeat, repeat, repeat. These are what the number values would look like. And then we're going to sell Nike on that 10th year. Right now, Nike has a market cap of $143 billion, meaning that it's trading at 23 times its free cash flow, meaning we could probably get away with selling it at the same multiple if the growth of 13.4% continues. We're going to now add up all of these numbers, and we're going to see that Nike's actually worth $560 billion. But wait, here's the problem. If you offer me $100 today or $100 a year from now, there is no reason for me to not take the $100 today. $100 a year from now not only loses its value from inflation, but also the opportunity cost, meaning the opportunities we miss out on because we don't have it today. So every year, along with growing the free cash flow by 13.4%, we have to be discounting it as it gets further away from the present day. I've seen discounts as high as 30% and as low as 5%. It really just depends on your investment goals and how secure you think that money is for that company in that industry. For this example, I'm just going to do 15%. Adding the discount to every year now changes our numbers to look like these, and the company value is now going to be at $155 billion. That means we're still pretty undervalued, right? It's time to buy and make billions of dollars. Okay, there's another problem. Actually, a lot more fucking problems. Remember when I said the market was efficient? If the market is super efficient, why is Nike not trading at or above its intrinsic value? There is a bigger likelihood that I made a mistake than there is that the market is wrong. Number two, Nike is run by people. I think. The CEO can literally have a video of him posted tomorrow of him saying the N-word, and the entire company is going down. So to protect yourselves from mistakes in math and unpredictability, we add a margin of safety. A margin of safety is just a discount you want to see before you sink your teeth into a new investment. Like if I'm looking for something on Facebook Marketplace, I don't want just a discount, I want a deal. The bigger your margin of safety is, the better, because not only does it make you safer in your investment, but it also gives your investment more room to grow in case you are too conservative with your margin. Usually when I try to tell people what it is, I either get glassy-eyed looks or they say cool, indicating to me that the conversation is over. This isn't even half of what I do to look at stocks, but it's just a nice introduction because so many big investors do it. And eventually I'll get to the other stuff, but for now that's it. Also, as a final disclaimer, if you listen to a guy on the internet for investment advice, you're actually retarded.